Welcome, my friends, to Dealmaker Live. Today we got some awesome content for you. This is the place where real estate entrepreneurs come together to learn, to grow, trade some secrets, and we're going to be talking about things that are in the news, things that are going on in the economy, and how it can affect your real estate investing career. Today I want to talk about California. I'm from California, I live in Los Angeles, and there's some new things going on. Some new things going on in California. They say, as goes California, so goes the nation. And we have just passed, when I say we, I don't mean me, I mean California has just passed or signed into law last week a statewide rent control bill. Now, California is not the first one to do this. We're actually the second state to have done this. Oregon signed into law a statewide rent control initiative just at the beginning of this year. And what they saw is actually incredible. For the first 3 months after Oregon implemented a statewide rent control mandate, they saw investing drop significantly, almost 38% over the next quarter. But by the second quarter after that law was enacted, investment activity was actually up, back not just to where it was, but actually had grown by 2%. So just a little bit of growth after that. What does that tell us? What does that tell us? Are investors hungry for rent control buildings? Why would somebody want a rent control building? Is this going to scare investors out of the state of California? Did it scare people out of Oregon? And what does this mean for your state or other states that we invest in? I know my firm invests in multiple different states. We have assets across the country in different markets, and we use different strategies to do the best we can in each market and to utilize those markets and what's going on in the economy to maximize our investor returns. Now, in a previous show, we talked about the different strategies as to what you would want to deploy in order to accomplish certain things in different markets, right? We talked about investing for long-term appreciation. We talked about investing for cash flow. And we talked about doing value-add deals and when to use those different strategies. So if you haven't seen that episode, make sure you go back, check out our YouTube channel at Matt Skinner Investments on YouTube, and you'll check out some past shows on there. Check out that show and you'll understand what we're talking about with that. But suffice it to say, a lot of investors like rent control buildings. So let me tell you why. Let me explain that just a little bit. See, rent control puts stability into the marketplace. When rents are regulated, and that's literally what rent control does. In fact, let me back up for a second and just tell you what California did was they said no landlord can raise their rents on a unit more than 5% a year and plus inflation. So I don't know how they're going to calculate the inflation part, but I know LA has had rent control for many years. One of my very first apartment buildings I ever bought was rent controlled. And the way that they do that is the city of Los Angeles would put a committee together and they'd come in, have a conversation about the economy, where things are going, and then they would make sure that they were granting or allowing, if you will, what percentage of rent increase they could have. Now that only applies to existing tenants. So if you have a vacant unit, you can set the price at market and you can move forward. But if you have tenants in place, you can only raise their rents 5% each year plus inflation. Now, what does that do for California investors? Well, according to the last 5 years, rents have raised in California 5 to 7% annually, meaning they've already gone up more than 5% typically over the last 4 or 5 years. And so what's important about that, there is a limitation on how much rents can be raised, but we're also seeing this is a strong, healthy apartment market. In fact, California has the largest population of any state in the country, and we also have the highest demand for rental housing. We have high home prices, high real estate values, and we have people that can't afford to get into a home, an entry-level home at $700,000, $800,000 in most areas in Southern California. So what do they need? The solution to that is providing affordable housing, and I don't mean the affordable like government subsidized, I mean affordable like lower cost options like renting instead of buying a home. And that's why we have such a high increase, such a predictable increase of appreciation of rent raises in California year in and year out as the economy grows. So over the last several years, we've seen 5 to 7% rent increases in rents in California. Governor Gavin Newsom has capped that at 5% plus inflation. It'll be interesting to see what happens in California And if we mirror what went on in Oregon, we might see a dip in demand, and then we might see a resurgence in people buying. Now, I just want to point out that I'm going to tell you, I don't think there's anything wrong or anything right with rent control. In fact, let me say that a different way. I think the government should stay out of all of our business and have less regulation across the board in everything. However, from an investor standpoint, we can only play the game that the rules are written for us in the laws. And so if you're an investor, rent control has some advantages. What are the advantages? Stability, less turnover. People are less likely to move out when their rents are predictable, something that they can look forward to, right? Something that they can count on, that rents aren't going to rise so much from year to year to year. And so the stability that comes with a rent control market is very, very strong, especially if you're investing for appreciation, and especially if you're investing to make sure that your capital that you've invested is consistently appreciating year after year after year. And so rent control markets are good for that. But if you're investing for cash flow, this may not be the market to be investing in if your sole purpose is to produce cash flow out of these assets. Looking at this article, by the way, I just got this article off of CoStar, and the title is California's New Rent Control Law May Have a Limited Effect on Apartment Investors, executives say. Now, obviously, this is coming from an apartment, a pro-investment platform, CoStar, but some good information in here nonetheless. It says, over the next year, over the next few years, some of the strongest apartment markets in the country will be the San Francisco Bay Area, the Inland Empire, San Diego, Orange County, and we'll see Los Angeles in there as well. Why? Huge demand for rental housing, huge demand. In fact, the government has a little role to play on the other side of this too. It's very difficult to get permits to build new multifamily apartment complexes in California. It's just the way the laws are here. It's tough. It's challenging. Other states are a lot easier to go in and develop and build new things in. California is challenging. But what does that do for the investor? If you're building new apartment complexes and you have permits and you're able to create new supply to the marketplace in a market that's already overwhelmed with demand, that supply and demand ratio is really going to take care of itself. So when you're able to develop new apartment complexes in a market that has a restricted supply of apartments, you're going to make some good money doing that. And that's precisely what we're looking at. We've been looking at several brand new development deals in Los Angeles, a couple deals in Orange County. We got some things in the works, and we're really liking new development stuff, even not in spite of this rent control, statewide rent control initiative, but partly because of it. Of course, we always love cash flow, and we'll always do value add deals, but that's my take on this new law. I'm just going to say, if your strategy is for appreciation, if your strategy is for long-term growth, rent control might be a nice, safe place for you to be investing your money. In just a minute, we're going to go live with some questions. I got some actually recorded questions from people that called into our hotline. We're going to release that number for you in just a bit. We're going to bounce over to that. We're going to run a couple of questions, and I'm going to answer these questions for you and for the callers. I think we're going to be talking about, what are some of the topics we got here, Lane? We got 401k, somebody's asked about cryptocurrency, among other types of investment questions. I'm excited to do that for you. We'll get back to that right after this break. Hey, Matt Skinner here. Everyone asks me, how are you able to consistently beat the market investing in apartments? And I answer, it's all about my secret sauce. There are 3 ingredients to my secret sauce. The second ingredient is that I only buy from motivated sellers. My advanced marketing system attracts owners of buildings that have to sell, not just want to. So when I'm making deals, I'm dealing with sellers that are in trouble, and they need me to help them out. I've found that helping motivated sellers has enabled me to make the best deals for myself and for my investment partners. The second ingredient is that I only buy from motivated sellers. To learn the other 2 ingredients to my secret sauce, check out mattskinnerinvestments.com. That's mattskinnerinvestments.com. And while you're there, watch a video tour of one of my latest apartment buildings being renovated. And don't forget to download a prospectus about investing alongside me in my next killer deal. Go to mattskinnerinvestments.com. That's mattskinnerinvestments.com. Welcome back to Dealmaker Live. I am Matt Skinner, your host and the Dealmaker. Right now we're going to go to a couple of questions. We're going People have called in, asked me random questions. In fact, we call this segment Ask Me Anything, because you too can call in, ask me anything about real estate investing, about business, about any of the 5 pillars that I talk about in my book, The Dealmaker Manifesto. In that book, we talk about, that book's all about, not really about real estate, although I got a lot of stories in that book about real estate, but the book is precisely, or specifically about who you need to be in order to do and have the things you want in life. And so inside the Dealmaker Manifesto, I tell some real estate stories, I share some examples from my life, but in that book we talk about the 5 pillars, and the 5 pillars are this. In order to be a deal maker, in order to be able to do and have all that you want to do and have in life, you must be able to market yourself. You must be able to have influence, or what we call salesmanship. You also need to be able to negotiate, implement business systems, and have financial intelligence. And I got a feeling these calls we're about to take are going to touch on some, or if not all, of those 5 pillars. Here we go. Let's roll it.
Darren from Hollywood, and probably like a lot of people, I have a money raise question. We're a startup, been around for a couple of years. Our company is called Live Play. We focus a lot in the sports area. Just to give you a little more background, I would describe us as a media-based company, but we do have very deep roots in technology. And the reason that is that we've been developing technology to make the acquisition of content and media less expensive. We all know the old adage that content is king, and that's more and more important every day. So I'm curious, in what we've been going through, what your opinion would be on raising money through institutional investors, a company that has some background, has some revenue, has been completing and moving forward on all of their directives and things that they need to do. Doesn't feel exactly like being an angel investor thing, but it may not fit into the standard institutional investment realm. So again, we're a company that does have revenue, and it has been growing, and we're continuing to grow and move across the country. So I'd love to get your opinion on that and hear what you have to say.
Awesome. Thank you, Darren. That was a great question. In fact, I love answering questions like this. Not really a real estate question, but more of a capital raising question. And actually, I've been raising capital since I was 25 years old. I raised money for some condo projects. I've raised money for some new development custom homes in my mid-20s. So I've been doing this a long time. But Darren, the question I think that I got out of that, if I could just synthesize it all down, was you have an existing business. It's post-revenue rather than pre-revenue business. And the question is, should you go after institutional capital, or should you go after more of an angel type of capital? And the first thing we have to do to answer this question correctly is to break down what are the two, mostly for you, but also for our viewers at home. What's the difference between institutional capital and angel capital? And I've had a little bit of experience on both ends, a lot of experience on the angel side, and raising money directly for our own endeavors and for our own private equity group. But I'm also involved in a member of an angel investment group. And if you've watched the show Shark Tank, it's kind of a made-for-TV dramatized reenaction of what an angel group does. Our angel group, called Tech Coast Angels, meets once a month. We have usually 3 or 4 different new entrepreneurs who have been pre-screened by somebody in our group. They come in and they get 8 minutes to pitch our investor group on why we should invest in their company. And it's all tech companies, medical devices, technology, and all these things. I actually first found out about it because I went there and pitched myself and raised a couple $1 million from our group, and we've been investing in real estate with that. But real estate's not really the type of deals you're gonna see at an angel capital group. You're typically gonna see companies like yours that are just starting to have some revenue and just about to, looking for more capital to expand. Now, any investor wants to see revenue from the company, not necessarily profit, but just that people are actually buying what you got to sell. And secondly, what they want to see is that you have some kind of intellectual property or some kind of idea that's already protected that can't just be knocked off by the next guy, right? If your idea or your technology can just be copied tomorrow, there's not really a lot of value in that. But if your tech company has a pending pending patents pending, then you have some real value in that because you're able to protect your product, protect whatever system it is that you've created. Now let's get back to this question. So the first thing when a company starts, you're usually going to do a friends and family round. You're going to go around to your friends and family, maybe even use your credit cards and get your company started. That's like startup funds, or what we call seed capital. And then as you go along and you develop your patents and you develop your technology and you start seeing that it works, you're still pre-revenue. You haven't sold anything yet. And you're starting to look at this and you're starting to need more capital to start growing. And that usually happens right when you begin to sell your product, right? You're starting to get more orders than you can handle. It's time to expand. You might need some new coders, some customer service. Maybe a sales team needs to get out in front and really sell this technology and this product. And so if that's where you're at, the next round you're going to want to get into is the angel round. Now, angels are usually accredited investors, high net worth individuals, or high income earners. And these folks are going to be investing in startup companies. I do it myself. It's a lot of fun. And if you invest, a significant amount of money, angel investors can oftentimes get a board seat and be an actual advisor to the entrepreneur that has the startup or the tech company. Now, next level of financing is institutional, which is usually called, is usually going to be a equity group, a capital group, something like that, who's going to come in and inject a large portion of capital, usually distributed in tranches as your company hits certain benchmarks. But they're going to do that in exchange for a large slug of ownership. And so I think you're going to find your best deals by starting in your seed capital rounds with friends and family, leveling up back up to angels. Angels are usually going to be utilizing a convertible note to invest in these startup companies. And then as you grow, the venture capital groups, the private equity groups are going to, if your company's doing well, they're going to start looking to you. They're going to be looking at you and your company because you'll already be on the map, you'll already be financed, and they'll just be there to help you grow, take it to the next level. So depending on where your company's at, falls in that pipeline, would depend on where you should pursue your capital. So I'll say, just to sum it up, if you're in seed round money, friends and family, that means you probably pre-revenue. Once you start having revenue, maybe not even profits, is about when you're going to start taking your company and your shares and talking to angel groups to invest in you, which is typically looks like a group of private individuals all investing in your company. And then the next level, when you start making a profit, when you start showing that the company is viable, that this is a scalable model, that's when you can go to venture capital and get a bigger slug of money. And then the last step in this game is, if you decide to, you either exit by selling to another technology company, somebody wants to consume yours and take on the technology, or taking it public. Either way, it's you got a lot of room to grow with your tech company, and a great question nonetheless. Not a lot of people get involved with this. In fact, one of the things that we see is this show, Shark Tank, has actually been a huge catalyst for entrepreneurism. People see that, oh my gosh, you can actually raise money and get money to start your business by doing it this way, and it's pretty powerful. I was 23, 24 years old. I had a construction company. I was building some amazing homes in Los Angeles, places like Malibu, places like Bel Air, Beverly Hills, Hollywood Hills, things like that. Some killer houses on these cliff sides. And I started getting into, hey, I want to start building some bigger projects. And to do bigger projects, I would need to find, in my mind, investors that had a bigger checkbook. And so one day I was hanging out with my grandfather, Jack, and he showed me an investment that he had made in the early 80s, actually, in an apartment complex in the San Fernando Valley, one of the hottest markets in the country. And he showed me the prospectus. And at the time, in this prospectus, it was like a $5,000 minimum investment to get in on this deal. And my grandfather was like, man, we have over the years had cash flow, paid out every quarter, and now we're selling it. He was cashing out like over $100,000 on this $5,000 investment. Killer deal. But what happened for me in that moment was I no longer was looking for one partner with a big fat checkbook, but it enabled me to see a new vision. It enabled me to open my eyes that what if I had 5 people all put in a little bit of money, or 10 people all put in a little bit of money? And what that does is reduces each one of those investors' risk and allows them to be more diversified in the marketplace by being able to invest in not just one of my deals, but many of my deals. And so that's where that light bulb came on for me. And I think that the shows like Shark Tank are really being, the messenger to the marketplace, and a lot of entrepreneurs are seeing new ideas and new ideas on how to get funded. So pretty cool stuff. Let's cut to our next caller. This looks like.
Hey Matt, it's Chris.
It's Chris.
I've been working at Northrop for 5 years and paying into my 401k, and I've been told I can use it for other investments. Is that true?
Woo! The question is, he's been working for a company for a little while. I think he said 4 or 5 years, and he's put money away into his 401k, and he's asking me now, can I use that 401k for other purposes? And there's basically 2 answers to that. And I get this question all the time because we get incoming calls all the time. Matt, I got 150 grand in my 401k. I want to roll it over and put it into some real estate. The mutual funds that the company is providing me or allowing me to invest in are, they're flat. They're making 2 or 3% a year after fees and taxes. Like, this is not the growth strategy that I've been looking for. But people like the 401k because the company usually matches what they've invested in. That's where you get your kick-ass return, is when if you put in 5 grand and your company matches it. That's a huge return, and you should definitely take advantage of that. Now, the downside of the 401k is this. As long as you work for that company, you can't pull your money out. There may be some very, very few exceptions to that rule, but the reality is this. If you're working for a company and they've provided a retirement program called a 401k, they are typically not going to allow you. The employer, this is not a law. The law doesn't say you can't pull your money out. The employer says as long as you work here, you have to keep your money in the 401k. You can't pull it out or take it out, because it's your fees that are paying the administrator that manages that 401k account. So if you pulled all your money out and all the other people did too, then who would be left paying the bill to those managers who are managing a 401k with impotent returns, right? So the short answer of this is 401ks typically cannot be used for other self-directed investments while you still work for the company. And again, there are probably a couple of very slight exceptions, but for the most part, that's true. Now, here's another side of this. Once you left the company, once you decide, you've left for whatever reason, now you've got a 401k. Some people forget about them. Some people just leave them there. They don't do anything with them, and they sit there and just age for a long time. It's just poor stewardship, but it happens all the time. I see it all the time. You might even have a zombie 401k sitting somewhere that you've forgotten about. Just kind of money sitting there, you forgot about it, and you can't really access it anyway. So who's still in control of it? Your ex-employer. That's probably not where you want it to be. So once you leave a company, you could definitely take that 401k, roll it over into a self-directed IRA. You're going to keep all those same tax advantages. Obviously, your company's not going to be matching your deposits anymore, but as long as you can roll it over into a self-directed IRA, and then you can invest in real estate. In fact, I would say about 40% of our investors in all of our deals and all the real estate assets that we've acquired, 40% of them have invested through their IRA, whether it's traditional or a Roth IRA. So there are some options there that you want to consider and think about. And my investor concierge will be happy to help you answer any questions about that and help you administer a rollover from a 401k or maybe from even a different retirement account. So if you're looking for that, we'd love to hear from you. Be happy to help you out and get you plugged into some high return investments. You'll see in a few minutes when we run this little video spot in a couple minutes, we've got a program called Simple Growth that pays out a simple 12% interest a year. Super simple. People are loving it, love getting the checks, love getting the cash flow. It's super easy, it's super simple. I want you to check that out. Also, our apartment deals have a much higher return than 12%, and we've had folks do really well and be really happy investing in those as well. Let's go take another call right now. Let's see who we have on the line.
Hi, Matt. This is Angel in Florida. I've recently come into some money, approximately $280,000. I make about $45,000 a year. I have 3 children. The oldest is 10. I would like to divide that $280,000 into equal sections for the children, approximately $75,000 each, which would leave me with about $55,000. I have about $25,000 in debt that I would like to put some of that money towards and wipe it out completely. which would leave me with 30,000 to play and invest with. I'd like to know, first and foremost, what type of account should I put the 75,000 per child into, or if it's beneficial to wrap it up all into one lump sum instead of 3 individual sums. And what should I do with the 30,000 that I would have remaining as far as investing? Do I have any money that should be allotted towards cryptocurrency, or should it be put in some different type of account? Thank you.
Another great question. So he's asking about, he's got an inheritance. He makes about $45,000 a year. He's thinking about wanting to divide this inheritance that he got of, I think he said $280,000, into each of his kids' accounts, which is about $75K a piece, as he said. He said, that'll leave me about $55,000, and I've got some debt to pay off. And so first things first, I would say, number one, it's my understanding that you inherited the money. It's also my understanding that your children are not adults. And so in that case, I would suggest to you that you don't divvy up the inheritance. Wait till you die to pass that inheritance down to your kids, right? Use that money to bless them, to help them, maybe put them through school, buy them things that they need. But I don't think giving each of your kids $75,000 is a wise move. I don't think giving your kids large chunks of cash ever is a wise move. I think that you should be the steward over your money and utilize those funds, this inheritance, with your best skills to be the best steward of it, which is why you're calling today, right? So let's talk about debt for a second. If you've got a mortgage on a house or mortgage on real estate or debt on anything that produces income from you, that's probably good debt for you, right? So I would suggest you keep that. If you have a house, if part of the $20,000 or $30,000 in debt that you were just talking about is on your home, and you're able to write off the interest for that, I'm gonna suggest that you keep that in place. Any other debt that's bad debt, credit card debt, payment plans that you're on, student loan, stuff like that, pay it off first. Get rid of the negative cash flow that's sucking you dry. Get rid of the negative cash flow and start getting into a positive zone. Now, that leaves us with the second part of this question. What do you do with the rest of the inheritance, right? What do you do with the rest of the inheritance? Well, number one, get yourself a will, and in that will, or better yet, a trust, and that's where you're gonna leave this money to your kids. This is where you're gonna leave your assets to your children. So you're gonna pass it on, just like you had to wait for someone to die in order to get your inheritance, your kids should too. And I think that's just sound advice, as morbid as all of this sounds. That's what I would suggest for you. So where do we put this? You mentioned crypto. Obviously, you're watching a real estate show. I'm going to talk about that too. But where do you put some cash like this? Number one, I'm going to say put some cash away. Put some cash under the mattress, so to speak, so that if you have a rainy day, your car breaks down, some bad stuff happens, your roof blows off in a tornado or whatever, you've got some cash that's readily available for you, some liquid assets. And this is true for everyone. Secondly, what I want to see you do inside of this is invest in something that produces income. Now, a lot of times real estate's the go-to thing on this. It's super easy to invest in rental properties, and as you grow your portfolio and as you increase your net worth, we'd love to talk to you about coming on board as an accredited investor. We also have some into our development deals, into our apartment deals. We also have a program called Simple Growth where you don't have to be accredited, and it actually has a much lower minimum investment. You can earn 12% on your money just by investing in something like that. It's super simple. That's why we call it that. So I would look at something like that, but I'm gonna say, I want you to own something. I want you to own something that's gonna be producing income and cash flow for you, and I want you to pay down that debt, right? And I want you to produce more and more cash flow for yourselves, because cash flow is actually what's gonna create your long-term ability to quit your job, to get out of the rat race, and then begin to start working on becoming wealthy. So cash flow first, that's where I want you to invest. Like I said, you can invest with us, you can invest in Simple Growth, you can get involved in some things like that. You can buy your own rental houses, some properties near your house, and all of those things. In fact, if that's the route you want to go, I'm going to suggest you get in and you invest in a mentor and you invest in a network. So you could join our Dealmaker training, dealmakersociety.com, where we get together. You're going to get new training videos, several new training videos every single week. There's homework involved. You're going to go through a whole process step by step by step to become a deal maker. You're gonna learn how to market yourself, you're gonna learn how to sell, you're gonna learn how to negotiate, you're gonna learn how to put systems in place so your business runs even when you're on vacation. And last but not least, you're gonna learn more and more financial intelligence, which is what we focused on here today. So you learn the 5 pillars, and you're gonna learn about real estate, tips, tricks, techniques, and all the creative real estate financing solutions that are available out there, which is something that we specialize inside the Dealmaker program. So if you haven't checked it out, make sure you check that out, dealmakersociety.com. In addition to the videos that come out, we meet on Saturdays. I meet with all my deal makers for a session on a video conference where if you have a deal, if you've got a sticking point, if you've got a business challenge, you can come on, submit your deal, and I'll go over your business plan, your deals, and all the things that you're working on, and we'll talk to you individually about how to create solutions for yourself. And everybody else in the group gets to benefit from those questions that you've asked. Likewise, you're going to be able to benefit from all the questions that the other deal makers have. It's just a super powerful network place for people to come, meet other investors, meet like-minded entrepreneurs like yourself, and really get started in the income property, income producing real estate, which I know is where you want to be. So with that, we're going to publish the phone number live this week. You're going to be able to call in. You're going to be able to ask your questions. If you want to call in while the show is not going on, you can just leave a voicemail, just like we just had several go on right now. But if you want to call live during the show, we'll have somebody answer it, screen the call, and we'll put you on live where we can have a direct conversation about your situation in real estate or in business or, hey, in life in general. This is Dealmaker Live, and I want you to go out there and make deals and get paid. Are you looking for a simple, easy way to invest in real estate? Want to join an investment group of like-minded professionals who love investing in quality deals? I have the perfect solution for you. My name is Matt Skinner, and I've been a professional real estate investor for 17 years. I'm an award-winning builder in Los Angeles, and I have a multifamily portfolio worth tens of millions of dollars. My investor group invests alongside me in these deals, and they continue to do so over and over again because I do what I say I'm going to do, and I get things done. I get people asking me all the time how they can get involved with my investor group, how they can get invited to our events and participate in our amazing deals that have incredible returns. Right now, I have a super simple way to get started. It's called Simple Growth. Simple Growth is a debt fund where you can invest as little as $10,000 and earn a secure 10% interest rate on your money for 12 months. You get a quarterly check and all of your principal investment back safely in your pocket at the end of the term. It's that simple. The Simple Growth Fund is invested in real assets like cash flowing apartment buildings and commercial assets. It's short-term and high yield, giving you the best of both worlds. Anyone can invest in Simple Growth. It's easy and fun way to get started on your path to financial freedom. Click the link below to get the prospectus or give our office a call and we'll take care of you. $10,000 minimum investment, 12-month term, cash flow checks sent out every quarter, and it's approved for your IRA. It's simple, easy, fun, Simple Growth.